Torsten, we have to talk about the economy, and in some ways, sometimes it's divorced from what's happening in equities. And you can see that just looking at delinquency rates, what's happening with the consumer. Torsten, are you still making the argument that that tightening is starting to bite? That you can see that, say, beyond jobless claims, which came in much lower than anticipated this morning? Are you still seeing evidence that higher rates are biting?
Absolutely. So think about the bigger picture here, that the Fed is still trying to get the economy to slow down. And what has happened in response to Fed hikes is exactly as you're saying, Jonathan. We're seeing delinquency rates going up on credit card and auto loans. We're seeing default rates going up for high yield and loans quite quickly in the last 6 months. And we're also seeing bank lending slowing down. That's exactly what the textbook would have predicted. The Fed is in the process of slowing the economy down. And the result of that will, of course, also be that earnings will slow down. And if we don't get that slowdown, the Fed will just keep on saying, like they communicated in the minutes yesterday, well, but then maybe we'll just be still considering hiking even further. So if we don't get the slowdown, call it organically where we are at the moment, well, then we may all be surprised that the Fed might then begin to re-hike rates again. In other words, the discussion really here is that this is all happening with the backdrop of the Fed trying to slow things down. And they are succeeding on some fronts, but I think a number of these developments are completely being ignored by the stock market, including these slowing things that we're seeing on the consumer, on the corporate, and on the banking side.
To some extent, Torsten, the Federal Reserve needs to be blamed for that. There is a takeaway in the last month. This labour market is no longer a reason for this Fed to be hawkish. Do you think that's the wrong way of looking at this labour market?
Well, I think there's a number of, I do agree with what you're saying. It is still a bit puzzling why jobless claims continues to be so weak, so strong at these low levels. But what is important is that we have seen weakness in the unemployment rate. It troughed at 3.4, now we're at 3.9. It is trending higher. So, of course, we'll need to see another few months exactly what the weakness of the labor market is going to look like. But the number of job openings is coming down. The work week is coming down. You're seeing the warn notices has also been softening. Across the board, a number of the labor market indicators are suggesting that things will continue to weaken. We're also seeing youth unemployment has gone up quite substantially in the last 6 months. All these things point to weaker labor demand, which is exactly also the way that the Fed would be thinking about their rate hikes are working. It's just taking a bit longer time, partly because there were more excess savings and partly because of the fiscal stimulus that's still coming from a number of different fronts. So I still think that we should be thinking about this in terms of what is the Fed trying to do? They're trying to get inflation under control. That's also how we should be thinking about earnings.